class, and welcome to the video lecture for partnerships. The second learning unit covers calculating a partner's share of net income and some of the different ways this is done. We have some new terms to review before we continue. The first is salary allowance. A salary allowance is a method of dividing the net income of a partnership between partners based on a partner's services to the partnership. Salary allowance is the name of the method only. It doesn't mean the partner is getting paid. In fact, partners in a partnership can't be employees. The second term is interest allowance. An interest allowance is a method of dividing the net income of a partnership between partners based on the partner's capital balance. In this term, the word interest doesn't mean interest earned or interest expense. Instead, it means a partner's investment. Partners can agree to any method of allocating net income they want. They might use the salary allowance method, or the interest allowance method, or both, or neither. If the partners don't have a formal agreement, they are required to split net income evenly. Let's work through the various situations presented in the textbook. These situations will be based on the following facts. So we have Dot Alexander, John Sullivan, and Sheldon Brown invested $8,000, $6,000, and $4,000 respectively in a partnership. These are their beginning capital balances. The partnership in the first year had a net income of $24,300. Recall that net income is closed out to capital in the closing process. In this case, we have three capital accounts, one for each partner. We need to determine how much is closed out to each account. In the first situation, the partners could not agree on how to share net income of $24,300. So the law states that if an agreement is not reached on how partners share earnings, they will be divided equally. So $24,300 divided by 3 is $8,100 to each partner. We debit the income summary account for the full amount of net income and credit each individual's capital account for $8,100 each. If this situation involved net loss instead of net income, each capital account would be debited and the credit would be to income summary. In the next situation, the partners share net income of $24,300 in the ratio of their beginning capital investments. To find a ratio, you first determine the total amount. The total capital invested is $8,000 plus $6,000 plus $4,000, which equals $18,000. Now, to determine a ratio for each partner, you want the portion of each partner's capital balance as compared to the whole. So this is like splitting up a pie. The entire pie is $18,000. Alexander has 8,000 of this pie, so his ratio is 8,000 divided by 18,000. Likewise, Sullivan is 6,000 divided by 18,000, and Brown is 4,000 divided by 18,000. Now that you have the ratio for each partner, multiply each ratio by the total amount of net income to be allocated. Each ratio is multiplied by 24,300. The numbers we just calculated are used in the closing journal entry. We close the total amount of net income to each partner's capital account. Another common method of allocating net income is to use a ratio agreed upon by the partners in advance. The partners can agree to allocate net income however they like. An example of an agreed upon ratio is 3 to 2 to 1. This means the total is 6. You arrive at the total by adding all the numbers up. One partner gets 3/6, another gets 2/6, and another gets 1/6. This is called a profit and loss ratio. Now let's look at a situation where the partners have agreed to share net income based on a combination of methods. In this example, we have 3 partners. They agree to a set amount of salary allowance each, $6,000 to Alexander, $6,000 to Sullivan, and $9,000 to Brown. Then, after the salary allowance is satisfied, they agree to allocate an amount equal to 10% of each partner's investment, which is the interest allowance. Finally, any net income remains to be allocated. They have agreed to share it equally. Let's look at the steps involved in this allocation. First, we have the salary allowances. These are agreed upon amounts, so the dollar amounts don't change, and we list them first. Next, we determine the interest allowance for each partner. It's 10% of each partner's investment. If we go back to the details of the partnership on page 625 of the textbook, recall that Alexander invested $8,000, Sullivan invested $6,000, and Brown invested $4,000. So 10% of each of these is $800, $600, and $400. We list each of these amounts in the column corresponding to the partner. Those were the first 2 parts of the agreement. Recall from the last slide that after the salary and interest allowances were done, any remaining net income to be allocated would be split evenly. We need to find out if there's any remaining income. To do this, we have to add up everything that's been allocated so far and subtract it from the total net income of $24,300. We find that there's still $1,500 of net income left to be allocated. If we split that equally, each partner gets $500. So we add 500 in each column and find grand totals for each partner. When we add all these up, we get $7,300 for Alexander, $7,100 for Sullivan, and $9,900 for Brown. Notice that the total is $24,300, which is how we double check that we've allocated all of the net income. Now we can journalize the entry. We debit the entire amount of net income to income summary and credit each individual capital amount or account with the amounts we calculated. The final scenario discussed in your textbook is the case in which there's not enough net income to cover all the salary and interest allowances that have previously been agreed upon. In this example, let's assume we have a net income of $20,700. This will result in not enough income to cover the salary and interest allowances, so each partner takes a reduction in the amount allocated. This reduction isn't a loss, but rather a reduction in the share of profits of the partners. So here's the chart we made earlier. The first line is the salary allowance. Then we have the $800, $600, and $400 interest allowances we calculated earlier. At that point, we must determine how much net income is left to divide, but in this case, we don't have any. In fact, we have a negative amount. If we have $20,700 in net income to allocate, and we can't cover the salary and interest allowances, we subtract the difference equally from each partner. In this case, the difference is $2,100, so we subtract $700 from each of the 3 partners. Again, we total them up at the bottom. Alexander is allocated $6,100, Sullivan is allocated $5,900, and Brown is allocated $8,700. Notice these total $20,700, which is equal to our net income, and a double check that we've allocated all the net income accurately. Now we're ready to journalize the closing entry. We debit income summary for the amount of net income and credit each capital account for the amounts we calculated. This final slide is what the statement of owner's equity looks like for a partnership. It's the same as for a sole proprietorship, except we have a column for each partner. I want to emphasize that the allocations of net income to partners we just did increase each partner's capital account. They are not cash payments to the partners. Partners can get cash from the partnership by making withdrawals. I'd like to finish this learning unit with one of the textbook problems. Let's do exercise 17B-2 on page 647. A. Langer and B. Sharpless have decided their partnership earnings will be shared as follows. First, a 12% interest allowance on capital balances at the beginning of the year, and next, the remainder to be shared equally. Capital balances of A and B at the beginning of the year are $83,000 and $27,000 respectively. Net income is $19,000. It says record the journal entry to update the capital balances of A and B. Okay, so the first thing we have to do is compute the interest allowance, and it says 12% of capital balances. So for A, that's 12% times $83,000, which equals $99.60. And then we have B. B's interest allowance is 12% times B's capital investment of $27,000, which is $32.40. Now we need to determine how much net income is left in order to complete step 2, which is to divide the remainder equally. So far, we've allocated 99.60 and 32.40. So if we add those together, we've allocated $13,200. Our net income is $19,000. So how much do we have left? We have $19,000 minus $13,200, which is equal to $5,800. So we have $5,800 left to allocate. And if we allocate it equally between the partners, we divide it by 2. So $5,800 divided by 2 is $2,900 each. Okay, so let's add these up. A was allocated $99.60 from his interest allowance, and then the split at the end was $2,900, so that's $12,860. And B was allocated $32.40 for the interest allowance plus the $2,900 that was split evenly for a total of $6,140. Okay, so now we're ready to journalize this. I'm going to erase some of this up here to make some room. Okay, so our closing entry. So we debit income summary for the total amount of net income that we're closing to capital accounts, which is $19,000. And we credit A's capital for the amount we calculated of $12,860. And we credit B's capital for the amount we calculated of $6,140. Okay, Okay, so that wraps up Learning Unit 2. In the next Learning Unit, we'll cover the admission and withdrawal of partners.